What's up, everybody? Crypto Noah back with another video. Sorry for the voice. I'm a little under the weather after coming home from Michigan, but nonetheless, here today to provide you guys some value. So in this video, I'm going to show you my Pendle Finance yield farming strategy. Okay, so I'm going to briefly cover what Pendle Finance is, and I say briefly because we've already made two videos on Pendle Finance. One is a full fundamental deep dive. We went through the team, the tokenomics, how it works, literally everything. And I showed you my take profit strategy on how I plan on turning 50K into 2.1 million. And we are on Trizak. Okay, so I'm gonna show you my Pendle yield farming strategy. I'm gonna show you why I chose the particular chain I chose. I'm gonna show you how it's been performing as I've been in it a little over a week now. And I'm just gonna give you guys all of my thoughts. So before we get started, I do have to say that none of this is financial advice. These are my own perspectives, opinions, and research, and they should be treated as such. Always do your own research, but use this channel as a starting point. So first off, what is yield farming? What is Pendle Finance? So let's start off with what is Pendle Finance. Pendle Finance is bringing bond stripping on chain. Bond stripping is a multi-trillion-dollar a year industry, over $20 trillion per year. And essentially what you do in traditional finance, this is mainly a strategy for large banks and financial institutions to hedge risk and get a yield. You can separate the actual bond and the yield that the bond pays, right? But in traditional finance, you can only speculate on the current price of the bond and the current yield. What Pendle Finance allows you to do that's different is they allow you to speculate on future principal of the bond, on the future price of the bond, and the future yield. So if you think the yield's going to increase, you can go long the yield. Vice versa, if you think the yield's going to go down, you can short it. This is a revolutionary concept, and this is a huge pillar in traditional finance that institutions love. And the fact that they can speculate on future yields, institutions are already sopping this thing up, okay? Now, yield farming is a way to generate passive income through providing liquidity on decentralized exchanges. You can do it on money market funds like Aave, get a yield. You can stake on a blockchain's mainnet, like for example, Ethereum proof of stake, you can get a yield doing that. You can stake on Nexus Mutual to get a yield on insurance premiums. But the most profitable way to yield farm is to provide liquidity on decentralized exchanges such as Uniswap, such as Trader Joe, etc., etc. So as you guys know, Pendle is one of our largest positions here. We called Pendle Finance out in November when it was 50 cents, and it went all the way up to $7. And if you guys want to get access to our buy and sell calls early and our yield farming course that teaches you the same market making strategies that mainstream banks and financial institutions have been using for centuries to generate passive income and beat out the benchmark, click the link in the description and book a free strategy session. We'll love to hear from you, tell you what we got, and see if it's a good fit for you. I digress. So Pendle's one of my largest holdings, and I want to accumulate a fuck ton of it, right? So I'm providing liquidity for Pendle and Ethereum. Let me show you how I went about setting up the position. So if you go to CoinGecko and you look at Pendle, you can see it's a $962 million market cap. And you can see that Pendle's on different chains. So it's like, which chain do you yield farm on? Well, you want to find the chain with the highest volume to TVL ratio. But another thing you have to think about is what happened in the past doesn't guarantee the future. And if I think Pendle's going to explode, I want to be on the chain where I think it's going to have the most trading volume. Okay, so first I'm going to back test and then I'll tell you how I made my decision. If I scroll down, you can see where most of the trading happens on Pendle. So you have Gate.io. Normally this is in order, but this time it's not for whatever reason. But we want to look for the decentralized exchanges, not the centralized exchanges, right? So if we go to 3, you can see that 6.7% is happening on Uniswap v3 on Arbitrum. And then you can also see that 1.9% is happening on Ethereum. Now, this isn't always correct. A lot of times it is. So what I want to do is go to Uniswap. So here we are on the ETH network, and you can see that you have a TVL here of 3.4 million, but you have a 7-day volume of 12.3 million. And you have a 1-day APR of 10.755. Now, you don't really want to look at the 1-day APR because the APR you get is going to depend on how wide or narrow your range is, because you provide liquidity within a certain range. I'm going to show you guys my range and how to go about that. But the 7-day trading volume is 7x the TVL. And then if we look on Arbitrum, you have a TVL of 13 million, but a 7-day volume of 52.4 million. So this one has always also been around 4x the volume. And you can see that they're both 0.3 and 0.3. So it's just like, which one do I do? Well, for me, when I originally did this, Ethereum was more, right? And I chose to provide liquidity on Ethereum just through backtesting. So if I go to metrics.finance, I put in my ranges. Let me show you guys my ranges first. So I provide liquidity from these ranges here. This is Pendle wrapped ETH. And when you're providing liquidity, you want to make sure that you're on price and you're showing it in ETH. Because if it's in USDC, the numbers aren't going to line up correctly. And when you go to provide liquidity on Uniswap, you also want to make sure you have Pendle first, and the same when you backtest. You see I have Pendle first and then ETH. When you originally go on here, ETH is always first because it's ETH. So why did I choose this wide range? Well, I want to give it room to run on the upside or the downside so I can capture the yield. And what I mean by that is, I think Pendle is going to outperform ETH in this bull market. So I have my range, I'm giving it 111% of price range to go up and down, right? Before I'm out of range. Now, what will make me readjust my range is if I see a break and a retest and a green candle close on top of the weekly. Then I'm like, okay, momentum's up, volume's up. We're probably going to a new level. So even if it goes out of range, I'm not rebalancing until I see a break and a retest and a close on the weekly. Same to the downside. Now, you might be thinking, well, you can get a much tighter range and get a higher yield. So let me show you guys something. One of my favorite quotes is time in the market versus trying to time the market. So if you look at this chart, and we talk about this in our course, it shows the cost of time in the market. So it shows the value of 10,000 invested in the S&P from January 2003 to December 2022. So if you were invested all days, your value of your investment would be worth $64,844. If you missed the best 10 days, your value would be $29,708. If you missed the best 20 days, $17K. If you missed the best 30 days, and if you missed the best 40 days, you would actually be under, on to 50, on to 60, right? Time in the market versus trying to time the market. So guys, there's no chart for that on yield farming. If someone wants to make one, by all means, but it's the same exact thing. Like right now, the yield isn't super crazy, but this is like selling shovels during a gold rush. And we teach people in our course, in our community, how to provide liquidity for assets in a way to where you can capture the volume when it does come so that you can be in the market when the best days happen, because it's going to make a huge difference in your yield. Just like being invested into the S&P or in Bitcoin or any other asset on its best days is going to dramatically increase your performance. So I want to be wide enough to where I can give this thing a lot of room to move, but I can still capture the yield. And the reason why I picked Pendle ETH is because as we're going into a bull market, the best pairs are volatile pairs. If I did Pendle USDC, it would be so hard to stay in range because it's 7x since November. But this one is better because if ETH rises, Pendle's on ETH, that means Pendle's an oscillator, is correlated. Pendle's going to rise as well. So that means it's going to be much easier to stay in range. And once people are trading ETH for Pendle, Pendle for ETH, I'll be able to capture that yield, right? Versus, yeah, if I make an extremely tight range, I will be able to get a higher APR. But like I said, I don't want to miss the day when people are accumulating Pendle by the droves and I can capture a quadruple digit yield for a certain time, right? So I want to cast a wider net on this one. It may not be a bad idea to put a little bit less money and make a tighter range. That's fine. But I'm in other pools that are paying pretty good. So this is just a strategy that I'm going with. So let me show you guys the back testing results. If I back tested on ETH, you can see I did 60 days and I put in my ranges, my minimum, my maximum, $4,000. For the past 60 days, I would have gotten a 55% APR. You know, it's nothing to write home about, but it's much better than anything you can get at a bank. And you're getting paid in ETH and Pendle for not doing jack shit, right? And like I said, this is going to dramatically increase once people start to buy Pendle by the droves, okay? For some reason, Arbitrum and optimism, like when I tried to back test it again today, like I had everything saved, but I did it before I went to Michigan. So when I came back, there were some issues with Arbitrum and optimism, but basically you put in the same numbers on each network and you calculate what would have paid you the best yield. But you always also want to think in mind, like, where do I think people are going to come buy this thing? I think people are going to buy on ETH because ETH is the safest. It has the most liquidity. This is attractive to institutions. They trust ETH over layer twos. This is layer two's first cycle, right? They probably worried about getting hacked. And then you have an ETH ETF that just got approved. So that makes ETH even more trustworthy. Yeah, the gas fees are high, But that's why I have a wider range, because I don't plan on rebalancing every day. Like, I've already made my gas fees back, as I'm about to show you. So on Arbitrum and Optimism, my Pendle ETH position with the same numbers would have outperformed. It would have been better if I was on ETH versus Arbitrum and Optimism, and I think that's going to be the case for the future as well. So if we look here, you can see that I've been in this position for 11.8 days. So not even 2 weeks yet. Right now I'm getting 90% APR. Okay, I'm not mad at that. And you can see I have $120 in uncollected fees, $125, right? Now this is going to go up dramatically once I have those days where Pendle goes crazy, and I want to make sure I'm in range, right? That's the most important thing. So guys, with that, I'd like to conclude this video. I hope you got value. If you did, consider dropping a like, consider subscribing, leave a comment. Let me know what else you want me to cover on the channel. And like I said, if you're interested in learning how to do this professionally, click the link in the description and book a free strategy session. We'd love to hear from you. But other than that, I thank you so much for tuning in. I love every single one of you watching, and I will see you guys in the next video. Take care and trade safe.